Street Check, the best podcast in the history of Cabot Wealth Network, which has been delivering insights, investment ideas, and research since 1970. I'm Chris Preston, Chief Analyst of Cabot Stock of the Week and Vice President of Content.
I'm Brad Simmerman, the Web Editor and Chief Analyst of Cabot Wealth Daily. This week, we're going to talk about the brief market pullback. Did we need it? Should we be afraid of it? We're going to talk about earnings reactions from stocks, companies being punished even when they beat, with the exception of a few sectors, namely Consumer Discretionary. Amazon reported last night. Then we're going to discuss record cash levels on the sidelines, specifically money market fund balances. And then we're going to have a broader conversation about kids and investing. Jacob Mintz, our Chief Analyst of Options Trader Pro, recently wrote a daily talking about giving his kids some money to invest, and we're going to have some conversations around what we can learn from the youth. But before that, Chris, you have a take to defend something about the Dow. You're going to have 90 seconds, and your clock starts now.
Okay, yeah, so my take is we should go back to using the Dow Jones Industrial Average as the primary U.S. benchmark. It's been the S&P for a long time now, even though the Dow is the oldest index dating back to 1886. I think we should go back to using it. I know it's only 30 stocks, but I think it's more representative of what's actually happening in both the market and the economy. So the S&P has become too weighted towards like 7 or 8, as we talked about many times on this podcast recently, mega cap tech stocks, Apple, Amazon, Netflix, Google, Meta, Nvidia lately. Well, the Dow does have Apple and Microsoft, but it also has things that are more of a diverse reflection of what's happening in the economy between Disney, Visa, Procter & Gamble, Nike, McDonald's, Coca-Cola, Johnson & Johnson, Goldman Sachs, Caterpillar Construction, Boeing. And so I don't think it's a coincidence that with S&P is up 17% year to date, NASDAQ's up north of 20%. Those are all mostly because of tech stocks and really a few tech stocks, whereas the Dow is up 6% year to date. And that's more reflection of what people are probably feeling in a normal portfolio, unless you're all in on tech stocks. The Dow is more reflection is more reflection of what's happening in the economy and by extension the market.
That's time.
Yep, I gotcha. And going back to let me just to tie a bow on this. So like in 2020, for example, Dow was up 7.25%, whereas the S&P was up, was it more than 20%? 2020, no one would look back fondly on that as being this roaring year for the U.S. economy when they were all in their homes most of the year. Amazon was responsible for a lot of S&P and some other companies, other big tech companies. 7% feels more reflective of what happened, and then 6% so far this year feels more reflective of what's going on with some of the concerns we have about the economy. All right, I'm done.
Yeah, so I think the NASDAQ reweighting is probably a decent bit of evidence in favor of your point, right? The NASDAQ had to come out and do a special rebalance because it was so dominated by the mega cap tech stocks. And like S&P has an equal weight, but the S&P 500 is obviously going to be driven by those. There's a case to be made for that. The only place where I'll split hairs is that when you get down to 30 companies to try and define the U.S. economy, there's a lot of discretion that you're putting on the indexers. So it's like, do we trust the market more, which the market cap weighting means we're listening to what the market is saying, or do we trust the indexers more? I think you can make a case for it. I don't know that.
Maybe it should be a Dow 60.
Yeah.
I don't know why they're so beholden to the 30 thing. Or a Dow 50.
Dow 100.
And one caveat I'll say is, in a bull market, I wouldn't want a Dow reflective. I wouldn't want a Dow like portfolio. You want to be in on the tech, on AI and mega cap tech, things that are red hot right now, EVs. Dow is more something the reason the Dow didn't fall much last year is because, or nearly as much as the other two indexes, is because it's diverse, the kind of diverse portfolio you want during downturns, like in bear markets, like we saw in 2022 and early this year. But now, you would want something that's maybe not quite as extreme as the NASDAQ, but more of an S&P like portfolio. But still, I think Dow is a closer reflection of what's actually happening.
Yeah, we talked about, the growth of like the metaverse and screen time usage and all that stuff. And, screen time use is actually declining this year for the second time in like the last 5. NASDAQ and increasingly the S&P reflect the digitized economy, maybe more than the real world economy. So if I had to make maybe like a mediating kind of pitch, it would be like, if you're investing in a bull market, look at the NASDAQ as your benchmark return. But if you're trying to gauge the health of the total US economy, look at the Dow. Like maybe that's the middle ground.
Yeah.
Let's talk about the state of the market. Market's off roughly 2% this week. Obviously, it's intraday on Friday, so we don't know exactly how it's going to end up. Mike and Jacob Mike Santolo, Jacob Mentz have been treating this as a well-deserved resting period, a break. But we're also, and we'll get to this more in more detail later, we're also seeing companies getting punished for good earnings. So what's your sense on the state of the market right now?
Yeah, I mean, I think this pullback is healthy. Pullbacks, in bull markets are good things. They're buying opportunities. And I think given what was expected of this earnings season, which we'll get into more in the next topic, negative earnings growth as much as 7% was expected. And so if some earnings blow up, especially among growth stocks, and especially among growth stocks that were already hitting 52-week highs or close to it, is no surprise. So like you said, close to 2% in the S&P, maybe a little more than that in the NASDAQ coming into today, and stocks are up today. I don't know how much. That's a pretty mild pullback. I think we should have expected some sort of pullback, especially during earnings season. And ultimately, I think it's a good thing. Not if it turns into 7 to 10% correction, but I don't think that's going to happen.
So what are you thinking for like September, October, right? Like that's traditionally when everybody's off summer break and the market sort of gets moving again. Because credit to you, you said, hey, sell in May this year? No, buy in May. May is the time to buy. What are you thinking for the fall months? Do you think that maybe we get some more participation from the institutional investors that can maybe drive us higher? Or are you thinking that they're still going to be content in their 5% sort of fixed income portfolios and cash yields, whatever they're getting?
I think we'll get more participation, especially given that what's happened this summer. I think which direction it goes right out of the gates. I know a lot of times when Wall Street returns beginning of September, that can lead to, is it October? This is the worst month on record for the S&P traditionally, or is it September? I can't remember.
October. I think October.
Yeah, I think it might be October. I know a lot of the biggest market collapses have happened in October.
Right. Yeah.
It might depend on how this earnings season shakes out a bit, but I still think the sentiment is bullish, and I don't see any like implosion happening once everyone returns from their yachts in the Hamptons.
Yeah. The fact that we're still seeing some companies beat on earnings and then rally significantly does tell me that it's not like everybody's just sitting on the sidelines, right? There's still cash that's being plowed into winning positions. So I think taking a cue from like growth investor and taking a cue from Mike and looking for leaders is probably a better option than selling wholesale, going to cash, or just throwing darts and buying blindly, right? It's like look for stocks that are moving on strength.
Yeah. And Mike said, so Mike's always, he's the best market timer we have, and frankly, one of the best in the industry. He wrote today, in terms of our stance, it's basically what we've been doing of late, but more so. If something keels over, we're either selling some or all of it, while on the buy side, you should be more discerning, looking for solid risk reward entry points and also some signs of support in recent days. There's no question that growth in general is weaker, while cyclical, oil, some metals, transports is holding up better during earnings season. But just about everything came under the gun this week. Yeah, so it's been a rough week for growth stocks. But he says, long story short, near term, play things cautiously. Longer term, the vast majority of the evidence is still positive. It's just a matter of getting rid of poor performers and holding a bit more cash. Yeah, I think we're just weathering an earnings-induced pullback, which is perfectly normal.
And, it's got sort of tones of the rolling bull market that Jacob was talking about when he was on here last, where people are buying into a sector until it seems to top out. And then you've got this quick rotation to other sectors that might be undervalued or have more opportunity. Drilling down specifically, and this is sort of a transition into our second segment. This data from FactSet from the 28th, it hasn't been updated this week, but companies that reported positive earnings surprises for Q2 2023 have seen an average price decrease of 0.2% from 2 days before earnings to 2 days after. 5-year average is 1%. By that same token, companies with negative earnings surprises only being punished by 0.7% in that same 4-day window, compared to a 2.2% decline as a 5-year average. But then you see a stock like Amazon, which last we checked was up 10% today on an earnings beat. And
DraftKings up 7% too.
Yeah, DraftKings up 7%. Royal Caribbean rose about 10% on earnings. They gave some back. So like these leaders are still benefiting from that rolling bull market, but it definitely feels like a rubber meets the road kind of environment where you need to come out, beat earnings, and then paint a picture for why that's sustainable, and not just say, hey, we got, this was a great quarter for us because this new sort of nascent trend is maybe popping up. You need to, if you're a company and reporting earnings, you need to paint a compelling story for why you can keep beating going forward. So I think investors have low expectations, right? Or earnings were down 7% quarter.
Yeah, that was the expectation coming in, minus
right.
7%. Yeah,
and we're actually like down 8.3 or whatever. So low expectations, but also low tolerance seems to be one sort of feature of the market right now, where investors are not particularly tolerant of companies that are just getting by or that aren't showing meaningful progress.
Yeah, and the fact that consumer discretionary, Amazon, the cruise lines, hotels, things like that are doing well. Auto is another area. I'm sure EV is a big part of that. The things we've been talking about in recent weeks is being hot sectors. You pick travel stocks to be the best performing sector for the rest of the year. We talked at length with Carl Delfeld last week about EV stocks. That's reflective of what we're seeing in consumer discretionary being the best performing in terms of earnings this season, and that also goes into there's no recession on the horizon. There, you would not see this kind of discretionary spending or GDP up 2.4%, or this morning unemployment dipped again to 3.5%. There's nothing pointing towards a recession right now.
Yeah, I heard, or I saw commentary by Ray Dalio, the fund manager. Andy Crowder, Cabot Option Institute uses a Ray Dalio portfolio as part of one of his services. He came out and essentially said, no, we're not going to have a recession. The reason is we have experienced this massive wealth transfer where the consumer is really, really strong, but now the governments are weak. So you're seeing like declining tax revenues for municipalities, things like that, but a still maybe not quite as exuberant, but a still very strong consumer.
Yeah. Let's move to number three in our big three. As you mentioned, Brad, there's a record amount of cash and money market funds, basically money on the sidelines right now. What does that mean? It means a couple things, I think. I think you said this $5.5 trillion on the sideline. Talk about what you think that means from both what it means going forward and what it means right now in terms of that much money on the sidelines.
So I have two data points: money market funds, total financial assets from the St. Louis Fed. Q1 updated June 8th, they observed 5.7 trillion in money market funds. Money market fund assets from the Investment Company Institute on July 27th, they said that it's 5.5 trillion roughly. Yeah. So there's a little bit of a reporting gap there. I would guess ICI is probably not counting some particular asset class or fund or something like that. But it doesn't. It's sort of a double-edged sword because it makes sense, right? Like if I can be in a money market fund earning maybe 4.5%, it's a little bit less than like a 90-day T-bill, but it's better than what I'd get in a 2 or a 10-year. And if I'm maybe not super bullish on equities for the rest of the year, parking my money in cash and getting 4.5 to 5% sounds fantastic. But it's almost $6 trillion on the sidelines. That's something in the neighborhood of probably 20% of the total S&P valuation. So it could have a significant impact in the event that it were deployed. My bull case would be if my bull case is FOMO, right? You put it that way when we were talking ahead of the record. Fear of missing out, right? If equities, if we see strong leaders continue to drive a bull market where we return maybe another 10% this year, or even maybe 8% for the balance of the year, so not counting returns so far, fund managers are going to have to start answering the question of, hey, the S&P's up 14% for the year, it's up 20% in the year, you returned 5%.
Right.
So, right, like that is when I think that's the best bull case that I can make, is that investors are going to demand returns that are commensurate with a combination of cash, fixed income, and equity exposure. And if your returns are 7% a year in fixed income and cash, that's good, but investor demand is going to be higher if the S&P is up 20%. So I do think that cash is going to have to get deployed, but it's going to be probably closer to the end of the year, when once more and more of the investing public sort of figure out that, hey, yeah, the bull market is real, the recession's probably not coming.
Yeah, I think there's a lag time, especially with the bulk of this sort of flip to being a bull market just before summer started, and it really became a bull market that was more than just AI and mega caps during the summer, really in the last 6 weeks. Yeah. June, July. So I think there's a lag time. People just who haven't been paying attention off doing summer stuff, even, hedge funds are out on vacation. Just like, I'll get to that in the fall. There's still a mistrust after being beaten over the head with a stick for, a year, not quite a year and a half, but 15 months at least, more than that if you're a growth stock or tech stock investor. I think there's, mistrust between, can the Fed still throw cold water on this? Is inflation really down? Is this really going down for good? Are we really not going to have a recession? There's a lot of mistrust in things that we've been told for over a year were going to happen, or were happening, or were weighing on the market. And so it's taking some time for people to wrap their heads around trusting the market again. And I think what you said, what it'll really take for this money to be deployed a lot more, this record amount of money on the sidelines to be deployed, and not in the high interest rates brought on by the Fed of money market accounts, is like you said, if there's another leg up in this bull market, which I think there will be before the end of the year, I think that'll feed on itself, and more money will be will be put to use in the stock market.
Yeah, I think when the Fed has their September meeting, if they come out and reiterate, if they come out and hold rates steady and reiterate that they don't see any sign of recession and that they anticipate maybe lowering rates in the first half of 2024, like if that language comes out of Jay Powell's mouth, I think that's a huge, that would be a potentially huge driver to get funds off the sidelines and into the market at the end of Q3 and then heading into the winter months. I think there's a good case to be made there.
Yeah. And the people who've been paying attention, especially to this podcast, know that we're, with 3% inflation and declining, and with the Fed pretty much all but saying that they haven't said it yet, but strong indications that was their last rate hike this year. That there's with odds of recession fading by the day, there's every reason to believe in this bull market. And I think people will wake up to that fact as they, come back online and see what's actually happening in the market. Okay, let's get to our theme, which is about children. No, it's about so Jacob Mintz, who we mentioned a couple times on this podcast a few weeks ago, wrote a great article for the cabotwealth.com website the other day. Actually came up on the website today. I gave my kids $750 to invest, and they bought these stocks. So his kids, let's see how old they are. Teenager, I think, both teenagers.
I think he's got a teen and a tween, but
and a tween.
Maybe like 14, 11, somewhere in that range.
His daughter said Apple. The new phone is coming out, and I don't know a single friend of mine who doesn't own an iPhone. Starbucks, my friends and I would go there every day if our parents would let us. Can we go to Starbucks later this afternoon? LVMH, Moet, Hennessy, Louis Vuitton. It's a mouthful. LVMUY is the ticker symbol. This is the company that owns Sephora, which is the makeup, skincare, fragrance company that my friends all buy. His son is the tween. Apple, same thing. Nike, everyone buys Nike clothes and shoes. And then digging deeper,
DraftKings.
Yeah, his daughter said Lululemon, Celsius. All my friends drink Celsius. Target, and then son said DraftKings. I see the commercials and the betting looks cool, which Jacob said we might be having a gambling conversation. And Uber is another one. So we decided this would be a good jumping off point. I asked my kids, who are not considerably younger than Jacob's, 9 and 7. I have to explain the whole investing thing. What companies they like, what stores they like going to, which welcomed a broad range of answers. But you, Brad, how old your kids are? How old?
My kids are 14 and 11.
Okay, same as Jacob, basically. Yours actually have accounts, right? Or one of them?
Yeah. So both my kids have custodial accounts with just like a core portfolio, like a 60-40 or 70-30. But then, one thing that I had always encountered coming up and sort of learning finance and being a broker is that, if you want to introduce your kids to investing, you get them stocks of companies that they think are cool, because then you can say, hey, this piece of paper means you own a piece of Disney. Every time you see Mickey Mouse, you own a piece of that.
Getting them Exxon or Procter and Gamble isn't going to exactly I'm terribly interested in investing.
I'm not getting them like Carrier Worldwide, but so my kids have positions in Unity, the software maker, and we got them Paramount Global a few years ago when they were still Nickelodeon fans. I think my daughter is largely aligned with what Jacob's daughter would say. She's on Apple devices constantly. Yep. She doesn't love Starbucks. She loves like boba. She'd probably want to invest in like a boba tea place. We did check in with the closest thing we have to a cool teen, our producer Madison, who said she would like Pinterest just based on the amount of time that she spends on Pinterest website. What I thought was interesting about this, and despite my efforts, my kids are not interested in investing. So, my son doesn't really care about money. He wishes we lived in an anarchy and everybody was just really nice to each other. so he's not exactly a red-blooded capitalist. Um,
Anarchists aren't known for being nice, but go on.
uh, so it did get me, I have sort of maybe failed despite my best efforts, but it did make me think about using youth interest to identify trends in general. Because ultimately the younger generation that's coming up is building brand loyalty. They're building a connection with these companies and in some degree or another. And then that's going to potentially carry through as they grow older, right? Like I still eat McDonald's every once in a while. I don't really like it, but I have like the brand has an enduring legacy in my brain. So the value there is that if you're identifying what they're interested in before they're old enough to invest, you can buy it now. And then as they start buying it and start investing in it, you're sort of reaping the rewards because you're essentially using the younger generation to identify a trend.
Yeah. Yeah. So let me tell you what my kids, so they're demographic from both Jacob's and your kids. Like I said, 9 and 7. They're pre iPhone, smartphone. They do not have smartphones, even they love picking up ours and taking photos and videos of themselves, but that's about the extent of it. So my son plays a lot of soccer. Nike, one of them. Target, he loves going to Target. So that was another one. They both said Netflix. My daughter still calls it Netflix, like it's a cereal. Actually, both of them called it that, but I think my son has finally learned what it's actually called. Amazon. My son, because he even though he's not, that online, he knows enough that we buy him things from Amazon. So they must be making lots of money. Dick's Sporting Goods, also because, he's into sports. And then my daughter, her two big ones, Disney, of course. She loves Frozen above all, but all things Disney. And we just went to Disney World a few months ago. And then she said YouTube, so that's Google. A little disturbed that she knows that much, is that excited about YouTube, but it's another conversation for another day. So yeah, I mean, it's like some of the biggest brand outside of maybe Dick's Sporting Goods, some of the biggest brands we know of. So I guess the message there is the biggest brands seep into every.
Yeah. So, you outlined a number of big brands.
The big brands.
One thing that I mentioned McDonald's just off the top of my head, but the fact that my kids love McDonald's, they've never thought about buying McDonald's stock. I wonder how much we should sort of take a brand exposure, sort of cautious yellow light with it, right? Like how much is a function of because we've got a little bit of an urban and rural divide. You're in a smaller town. I'm in a major metro area. So, my kids are naturally going to have exposure to a wider variety of brands. Your kids are going to have more exposure to maybe local companies that are not publicly traded.
Yeah, my daughter said her favorite store. I was like, "What about clothes?" She said, "Oh, Jamie Two Coats, because that's the local toy/clothing store." I was like, "Yeah."
Sounds like a mafioso. Hey, get Jamie Two Coats over here.
Yeah. I think my son mentioned some local creamy is a Vermont word for soft serve ice cream. I was like, "Yeah, I'll pitch that as well." Anyway, go on.
But like the picks. Across the board, the picks were good. Like I would not boot any of those picks out of my portfolio. Starbucks is a global brand with an enduring legacy, generally high quality products. They're, like they source well. They're environmentally friendly. Their workplace union activity is not great, but the same is true of Amazon and probably Google and any major corporation. But all those companies would be solid additions to any portfolio, and they're good long-term 10. Like you could buy any of those for the next 10 years.
Yeah, and the one that really stood out to me, my daughter mentioning Disney. It's down. It's famously struggled lately because of things that aren't necessarily like, its parks are killing it, especially now that people are back in the post-COVID world, especially we saw it firsthand and we were there. Disney brands are doing fine, but then it's things like what ESPN and ABC, like it's sort of, especially like ABC, they're weighing it down. It's sort of dead dinosaur networks, but the Disney brand is going to be around forever. And the fact that the stock is down 24% in the last 5 years, even though it's been really plummeting lately, feels like if you bought now and just held on for the next, if I bought my daughter Disney stock and had her hold on to it until she got out of college for like the next 15 years, I think she'd be pretty happy with the return.
Yeah, probably. When you look at Disney's liabilities, right? Like you look at the cord cutting and how nobody can turn streaming profitable. There was an interesting podcast called Factually with Adam Conover recently did a deep dive with an expert on the streamers into why achieving profitability is so hard there. But the risk to Disney in a change to how people consume and pay for content, right? Like the transition from linear TV to streamers is not an existential threat because of the strength of its portfolio of intellectual property. You could come up with a device that just beams content directly into people's brain and nobody ever looks at a screen again, and Disney is going to be okay because Mickey Mouse and Elsa and Anna are going to be there. So there is a moat that a company like a Disney or Starbucks or any brand with significant goodwill has, even while technology in the marketplace is evolving and changing.
Yeah. And I think the big takeaway is, these are the companies, if you're 7-9-year-old tweens, less extent teens, they all know about it. They all consume it. They're not going away anytime soon. And if you're looking to build a long-term portfolio, you could do worse than all the stocks we just mentioned, the 12 companies we just mentioned. If you built a portfolio, if you had a child build a portfolio, maybe if if you put together a board, an investment board comprised of Jacob's kids, your kids, and mine, and they came up with these stocks and just is buy and hold for the next 10-15 years, it would probably do quite well.
Beat me. Or I assume they would beat me. I mean, the counter indicator and all. So I think maybe one sort of summary takeaway from it is your kids or the younger generations are a good measure of management capacity to build brand awareness penetration.
Yeah.
Right. You can't ask your kid, hey, should I buy Facebook? What's EBITDA look like for the next year? Or what do the fundamentals look like? But it is a good metric of management competency, at least insofar as their ability to drive brand awareness. So it's definitely something that you could look to say, okay, well, I'm interested in companies that have strong brands. I'm not quite sure what sector is going to be hot next, but I want something that is effectively and well run.
Right. And is likely to still be around for the next generation of kids when it comes around. Okay. So that ends our discussion for today. We wanted to mention what we're going to do next week. So obviously at the top of every podcast, almost every podcast, we alternate having defend the takes, which, sometimes go way off the tracks and are woefully wrong. Well, now we're going to pay the price for our wrong takes. Next week, we are going to, I'll let you describe what we're going to do here, Brad.
So the takes
Madison's going to be helping us out. You can chime in on this as well, Madison, if you'd like, what we're going to do. But Brad, I'll let you set it up first.
So as the owner of probably the worst takes, I'll go ahead and introduce the segment.
That's why I deferred to you. Yeah.
The pitch for Defend the Take, when we were conceiving of when Chris was conceiving of the podcast and when I was contributing a little bit, was let's have some hot takes, something that people can listen to, and we can be either massively wrong or we can look like geniuses. And the outcome doesn't really matter that much, but they need to be bold takes. So we figured it was only appropriate to have commensurately bold consequences. They exist. We will be torturing ourselves with hot sauce. I believe that we're going to have
for every wrong take we've had. We're going to have Madison. Madison, we're going to have you read off not all of our takes, but the ones that had sort of a timeline. Like today, I talked about why we should go back to the Dow. That there's no like consequence for that one. That's just an opinion, really. But something like, say,
are you just trying to cover your butt?
Yeah, exactly. Something like me saying, "Oh, the Fed won't raise interest rates the rest of the year." Twice, I said that, defend the take. So that would be twice I would need to dip into a variety of hot sauce on air next week, right?
Yeah, and
spread.
So your connection not quite as great from the basement there.
Sorry.
So one thing that we wanted to do is give ourselves the opportunity to truly suffer. I recently bought a hot sauce that's 2 million Scoville, which is the temperature scale. That's going to be my major punishment. The others are going to be milder, but we'll go through the takes so far this year, and anything that has an answer will have a consequence, either right or wrong. And we will, in my case, take a dip of probably cauliflower into some nice spicy hot sauce, and you get to watch us suffer.
Cauliflower, wow. I think I'm gonna go just standard chip, but we'll see.
We're recording at 9 a.m. in Arizona right now. True. So next week, I don't necessarily want a belly full of tortilla chips and hot sauce alone. I think the
cauliflower at 9 a.m. though. Well, each their own.
It's better. What am I going to do? Make like chicken wings?
That's true.
I'm not going to have chicken wings at 8:30 a.m.
Well, I'm not having chicken wings the rest of the day. Madison, I think you have agreed to. So I think we're going to have a hat with all of our takes where we pull them out. Is that how we're doing it? We'll figure it out. We have some things to iron out next week. Madison, I assume you're looking forward to this.
I am, and you guys are lucky we're doing this virtually, because if it was in person, I'd be replacing all those hot sauces with the like really, really hot ones and above. Yeah. There would be no mild or medium.
Yeah. And I think our mild will probably only be somewhat mild, and I think our hot will be very hot. It's all about content. We want to give the viewers what they want. So yeah, this is obviously be more effective for people watching on YouTube versus at the Cabot Wealth Network channel versus listening. Maybe listening would be entertaining too, but that'll be next week.
And it's going to go out. It's for all the people that are listening that hear a take like Coinbase will be worth half of what it is now by the end of the year, and then watch it go up 60% and scream at their phone about how wrong I am. This is for you.
Yeah. There it is. So yeah, this is meant for the people, and now we're proving it next week in the form of torturing ourselves. Okay, so that's it for today, and that's what's on tap for next week. In the meantime, as always, if you have any questions, suggestions for next week, email us at streetchat@cabotwealth.com. Wait, did I just say street?
It sounded like you said street chat, but the actual email address is streetcheck@cabotwealth.com.
Oh man, I need to get out of here. And then, as always, please subscribe if you haven't already. Hit the like button, give us a 5-star rating, nice comment. All else. Anything else, Brad? Before we go,
mash that subscribe button, peeps. Bye.
All right. See you next week.